Hey everyone, welcome to the third episode of the Wilson versus NASDAQ. This week was probably one of the most confusing weeks for the investors in 2026, and I literally just deleted my IBKR app on Wednesday, and I think it's one of the main reasons for the Thursday's rebound. But anyways, um, at the beginning of the week, the AI stock were selling up aggressively. Semiconductor companies were getting hit, and investors started questioning whether the AI trade was finally losing momentum. Then, just a few days later, the market suddenly reversed. Semiconductor stocks bounced back, AI infrastructure names rallied, and investors started buying the exact stocks that they were selling earlier. So, what actually happened? Did the AI bubble burst, or was that just a normal correction from a massive rally? The answer is probably somewhere in between. The biggest story this week was not that AI was dead, no. The biggest story was that the market started asking a more difficult question. Um, how much should we pay for the AI revolution? So for the past 2 years, the AI trade was extremely simple. So AI needs computing power, and the computing power needs the GPUs, and GPUs means Nvidia. So the logic created one of the strongest investment in the recent history. But eventually, every market reaches the same point. Investors stop asking whether the story is exciting. They start asking whether the valuation made sense. So that was exactly what happened this week. The semiconductor sector came under pressure after reports suggested that China may be making progress in developing its own semiconductor manufacturing technology. Whether every detail of those reports is accurate is still, uncertain, but the market reaction tells us something important. The investors are worried that the technological companies may not remain as strong forever. So for companies like the ASML and semiconductor equipment makers, their value is not only based on current earnings. A large part of their valuation comes from the expectation that their technology advantage will continue for many years. So when the market started asking, what if the competitive advantage becomes smaller in the future, the stock price adjusts immediately. This is why great companies can still experience major declines. The business can remain strong, but the expectation become too high. And another major discussion this week was Nvidia. This question was not whether the Nvidia can sell chips. AI demand is still very strong, and the bigger question was whether the AI ecosystem is becoming too dependent on the financial engineering. So the investor started discussing AI. No, sorry. The the investor started discussing Nvidia's involvement in financing the AI infrastructure projects. The concern is that the industry could create a cycle. Nvidia invests in the AI companies, and those companies use the money to buy the Nvidia chips, and Nvidia will report higher revenue. So, and the stock price will go higher, right? But this does not mean the AI is fake. The demand for the AI infrastructure is real. So the Microsoft, the Amazon, Meta are spending enormous amounts of money building the AI systems. But the market is becoming more selective. So 2 years ago, the investors rewarded every company connected to AI. Now they want proof. They want to know, can the AI actually generate enough profit to justify these investments? Yeah. And the second major event this week was the Federal Reserve meeting. The Fed decided not to raise the interest rates. Normally, the investors would see that as good news, but the market reacted differently. Stocks initially moved higher, but then suddenly reversed lower. So why? Because the investors were watching the bond market. The long-term treasury yields moved higher, and that created pressure on the technology stocks. The high growth companies are especially sensitive to interest rates because their value depends heavily on the future earnings. So when the bond yield rise, those future profits become less valuable today. So even though the Fed did not tighten the policy, the bond market sent a warning signal. However, the biggest turning point of this week comes from something unexpected. A leveraged AI fund was forced to reduce its position after suffering the losses. This event reminds the investors of one important lesson. So a great investment idea can still fail if the position size is too large. Leverage will work both ways. It can make you rich very fast, but it can also force you to sell at the worst possible time. So once forced selling ended, the market quickly recovered. Semiconductor stocks bounced sharply, and the investors started buying back the company they just sold. So where do we go from here? Mm, my view is that the AI is not a bubble that has completely burst. The technology is real, the demand is real, but the market is moving from the first phase of AI investing into a more mature phase. So the first phase was AI will change the world, right? And the next phase is which company will actually make money from AI. So for investors, the most important thing is to watch the three factors. So the first one is the treasury yield. If the bond yield continue move higher, the technology stocks will remain under pressure. And the second one is the AI spending. So the market needs to prove that the AI investments can actually create the real returns. And the third one is gonna be the risk management. So after this week, the investor should remember that even the strongest trends can experience violent corrections. The goal is not to predict every move. The goal is to survive long enough to participate in the long-term opportunity. So yeah, that should be it for this week's recap. So like and subscribe if you find this video helpful. Yeah, and I'll see you guys in the next video. Have a good one. Bye.